The stock market is a leading indicator of economic times. It's not a follower, it is a leader. It's all about trying to keep you guys focused and knowing that there's going to be a down day. Wall Street makes money by transactions. The more transactions you have, the more money they make. So we had a really good year this last 12 months. Actually, if we go back probably about 18 months of some really good returns in the market. Early half of 12 was a little sketchy. We had the first couple months of 2012 was good. Then end of the third quarter, or end of the first quarter towards the end of the second quarter of 12 was a little up and down, a little volatile. And since then, we've had a pretty good run. And we had some great returns for 2012, or 2013. And so what happens is sometimes we get comfortable thinking that that's the way it always is. And so tonight we're going to talk about bursting bubbles, because things do burst. The markets do go down. We don't know when they're going to go down. We don't know if they're going to go down today, tomorrow, the next day, 6 months from now, 12 months from now. There's no way that we can figure out when those are going to go down or if they're going to continue to go up. So these are always issues, and most of you have been to class in here before from a la Professor Fike. You know that we talk about emotional behavior is the worst thing that can hurt the investor, because we do get emotional with our money. Our money is attached to us right here. And we are bombarded daily. Last month, or I guess it was November now, was our last class. And we talked about how how media, social media, internet, that includes internet, all the social media, television, radio, newspapers, they bombard us with fears and doubts. They create emotion. That's what they're trained to do. That's how they sell whatever they're selling. And a lot of times that's dropped on us over and over and over, and we become kind of engulfed with those negative thoughts. And so when things are really going good in the market like they have been, it doesn't really affect us that much. You hear a guy, oh, I think the market's at the peak and it's going to, we predict it's going to crash in the next 3 months. I saw a couple of those on the internet last week, and it's like, whatever. That guy they don't know any more than you and I know what's going to happen. But when the market's up, we aren't so emotional, right? I mean, is anybody really upset about the way things are going right now? Now, if I was sitting here talking and the market was down 15%, you guys would be emotional. What's going on, man? What's happening? Maybe we should get out. Should we move over here? Should we move over here? See, it doesn't happen when things are going good. We're just like, okay, it's good. It's all happy stuff. So this is why we do these education classes on a normal basis, regular basis, because we are human. We are going to be bombarded with negative crap that is all there to sell something. I promise you, whoever's making those statements has got something to sell to solution whatever fear they're creating. And so if we go to education classes, I do a lot of email sending. I do a lot of stuff just trying to keep you guys educated. I don't want you to think that it's bothersome. It's all about trying to keep you guys focused and knowing that there's going to be a down day. There's going to be a correction in the market. We could have another recession. We don't know when. There will be another recession. I can assure you we'll have another 2008 somewhere, sometime. Hopefully it's not for a long time, but we'll have that. We'll have another down year. 2011 ended up being a down year. Okay? 2008, obviously down year. 2009, we came out of it. 2010 was a decent year. 2011 ended up being a negative year. 12 and 13 being positive years. So 1 in 4, on average, if you go back to all the way in the back, 1 in 4 is a down year. Now, does that mean we're going to have a down year this year? I don't think so, but what do I know? I don't have a crystal ball. I don't have that power to be able to tell you that. So we want to talk about bursting bubbles. I want to keep talking about emotions and behavior, because we are our own worst enemy when it comes to investing if we freak out when we have a 10 or 12% correction. I can tell you I expect a 10% correction this year. I'm going to throw that out there because I really think we may have that. But I don't think it's going to be a long-term correction. We don't know if it's tomorrow. It may not be till December, and it may never happen at all. But I personally feel that we should have a 10% correction this year. Does that mean anything? No. Again, no crystal ball. But I guess my point to that is, if we have a dip, don't freak out. We've all sat down, we've been through everything that we decided to do. We went through all the process to learn where your risk levels are at. We are so diversified, we'll talk a little bit about that today. And we own all these different asset classes that if the market goes down a little bit, there's nothing we can do about it. And by moving around and getting in and getting out, it just creates worse havoc. It is more detrimental to your portfolio than if you sit through it. Okay? And we'll talk a little bit about we're not really sitting through it. Okay? And most of you all heard the little talk about rebalancing. So we'll bring that up a little bit tonight. So my little spiel for this year is we don't know, but be prepared for a correction this year. And I really, there's no economic reason for it to be a major long-term correction. There's nothing out there other than fearmongers wanting to create that. If you look at the financials of the corporate world, which is where do we get our returns from equities or stocks, it is from the corporate world. And the corporate world is a global world now, so sometimes it's really hard to block out all the negative media about government and how they're screwing everything up. And yeah, I don't agree with the way government does stuff, but look what the markets have done. Okay, they've done pretty well over the last few years, even though the government's screwing things up. And I really think they're two separate components. If you go back in history, go back to the early 1920s, the stock market is a leading indicator of economic times. It's not a follower, it is a leader. It's a sign of confidence. So if the markets are going up, people are getting confident, that means the economy is doing way better than what all the other signs. So you look and you see where unemployment and all these sales are down, all this other negative stuff. Remember, the stock market is a leading indicator. That means it leads what's really happening in the economic situation. So sometimes it's hard to stay out of that. But that's just because the news media loves it. And guess who feeds the news media? Wall Street, right? Wall Street makes money by transactions. The more transactions you have, the more money they make, so the happier they are, so they like to create that fear. So we're going to talk a little bit about bursting bubbles. Might be a little bubbly tonight. How's that? Oh, I'm so funny sometimes, all right? What is a bursting bubble? Bursting bubble is I'm going to read some of these first few and then we'll get into some different talk. But an economic bubble, sometimes referred to as a speculative bubble, is trade in high volumes. Things that are in a bubble trade at high volumes with prices that are different than what its intrinsic value is. What is the intrinsic value? So we'll talk about stocks specifically. The intrinsic value of a stock is what the value of that corporation is, not the market value of stock. So if you have a stock, the market value of a stock is what people are willing to pay for it. It goes up and down every day. That's the market value of stock. The book value of a corporation is what intrinsic value is based on. So in the stock world, the intrinsic value of a stock is what is that corporation really worth and how many shares are outstanding. That's what it is. It might be $10 a share, but it might be selling for $12 in the market. So what a bubble is when it's trading at prices that are higher than its intrinsic value. Does that make sense? So if the stock price is $10 based on accounting measures, that's where it should be. It's selling at 12. It could be a bubble. All right? So technically what a bubble is, it's when things are, well, first of all, the hottest thing going, right, is a bubble. And when things are trading higher than what they should be. And that could not only just be stocks, it could be anything. Can anybody think of a bubble? Anything, just think of anything. I'll throw one out there. Beanie Babies. Huh? Is that a bubble? They're worth nothing now, right? But boy, when they were hot, the intrinsic value was what? Probably 50 cents for a Beanie Baby, but they were selling for 12, 15, 20 bucks or higher. So they were going a higher price than what the actual value was. People thought that they would go on forever and ever. I remember reading stories where people were putting all their college money into those thinking that was going to send their kids to college. That's not working out real good. Hopefully those kids still got to go to college, but I mean, that's just what we get caught up in sometimes. So and bubbles come in all shapes and sizes. So this screen's just to let you know that you don't know what a bubble, bubbles can be a little bubble, big bubble, they're all in different sizes. So there's a little picture here for you tonight. And in a bubble, prices become inflated. Just like we talked about the Beanie Babies, the price is inflated, right? And when we're in that bubble, we don't know we're in that bubble, usually, right? If we get caught up in that bubble, we don't know we're in it. We think that these prices are never going to end, okay? We don't think that there's going to be any risk to that bubble. If we just talk about Beanie Babies, because it's an easy way to grasp it. So we think that it will never end growing. There's no risk. It's not going to be volatile. It's never going to go up or down. It's there for good because we're caught up in the moment. That's what bubbles are. And we're going to go show you the top 10 bubbles of history. So what happens to a bubble? Blows up in your face, doesn't it? So let's talk about the 10 most bizarre economic bubbles that have happened in history. This is based on a website from businesspundit.com did this little thing, so we're going to copy it a little bit. So number 10 on the list, this is the top 10 worst bubbles. Number 10 is the tulip mania. In 1593, tulips were brought from Turkey to Holland, and the Dutch instantly fell in love with this most charming of flowers. Beautiful flowers, so you can see over here how really. And by the latter months of 1636, certain varieties of tulips were worth more than their houses. Okay? So what happened is people were selling their houses to buy tulips because they were going so far up. And you can look this up on the internet. It's probably the first bubble ever. And their tulip bulbs increased 20 times in value at one point in a month. But these were overinflated prices, just like we talked about Beanie Babies. And it couldn't last long. Within weeks, prices fell to 1/100th of this value. So the term bubble, so to go back to that, here's all these people who actually got caught up in the bubble, didn't know the bubble existed, okay, because tulips were so valuable that they were willing to sell their house and their land to invest in these tulips because they were just going crazy, but they never thought about the fact that there's any risk to this. They got caught up in the bubble. They didn't know there was risk. They didn't know that this is not going to go forever, but they thought it was. So number 9 is the South Sea bubble. Now, that's a pretty popular bubble. Actually, it's where bubble got its name. You know, prices are in a bubble. But the South Sea was inflated stock prices from the South Sea Company. And it was a British joint stock venture between British and South America in 1720. And it was designed to return financing from the British government's war debt. And this was a time of lavishness and opulence in Britain. So they were all that in a bag of chips in Britain. And with many wealthy speculators desperate to invest in a company that wildly promised astronomical returns, trading wool and fleece for piles of jewels and gold. Now that's a pretty good deal, wouldn't you say? You're sitting on a bunch of wool and fleece, and people will give you jewels and gold. I'd be all over that too. But, unfortunately, shares in the company quickly reached 10 times their value, but when the bubble burst, many of the country's elite were destitute because they were sitting on wool and fleece and had given up for all this different stuff. So during that South Sea bubble, and this is the fellow that really made it famous, Sir Isaac Newton, and we all know that he's what? A genius? I mean, he like created calculus. He figured all the stuff in outer space, how to figure out distances, and he was just a real genius. But he said, I can calculate the movement of stars, but not the madness of men. So it just tells you, it isn't dummies. It doesn't mean you're stupid that you get caught in these bubbles. It can happen to anybody. Isaac Newton's a perfect example. Then we have the rhodium bubble, which is 8th on our list. The rhodium bubble of 2008 saw prices of this rare chemical element increase from $500 an ounce in late 2006 to $9,500 an ounce in 2008. So in 2 years, it went from $500 an ounce to $9,500 an ounce. And then before falling to $1,000 an ounce by January of 2009. So can you imagine buying in right here thinking, I'm in a bubble. Gee, it used to be a couple years ago 500, it's at 9,500. There's never going to be an end to this. I'm getting all over this. I jump in, and 6 months later, boom. Now I'll tell you, you didn't take a loss on that one. Nobody's quite sure what sparked the buying frenzy, but it seems to have been a combination of demand in the American car industry because catalytic converters, they use that in as a combination because it's rust. It doesn't. It's not susceptible to rust. And they think a bullish market in the rare metals and at least one rogue speculator. I'm pretty sure there was more than one rogue speculator out there that created it, but they really don't know what all started it, but once it spiraled. And I just looked today, by the way, on the internet, and it ended at 1,000 in January of 2009. It's now worth $1,025 as of today when I looked at it per ounce. So it hasn't gone up much since 2009. Pretty sure that bubble popped. So the next one is number 7, which is the railway bubble. Railway mania grew throughout the early 1840s, peaking in 1846 when a staggering 9,500 miles of railway lines were authorized, around the world, around a third of which were actually built, or never actually built. So a third of them weren't even built. And as the price of railway shares increased, more money poured in, largely from the new affluent middle class in the United States, that had risen from the smoke of the Industrial Revolution. So we got all these people making money in the Industrial Revolution. Middle class is now starting to make money, and they're looking at these railways that are just going crazy, so they jump in thinking this is where it's at. And as few had predicted, it ultimately became clear that building railway lines was not as lucrative and easy as investors had presumed. So the collapse was unavoidable, and many middle-class families lost their life savings as a result. And we see this happen all the time. When we have bubbles, people run to them, and sometimes they get caught up in it so much that it's devastating to the families. Sometimes they get caught up in so much they take their life savings and jump into this stuff, and then when the bubble pops, they've lost everything. It's sad. It's very sad that we get caught up in it. We're going to talk about how not to make sure you get caught up in it. Okay, then we have the Romanian property bubble, number 6. Romania is said to be the country with the highest house price to income ratio in the world. The price of an old communist-era apartment rose by 1,000% between 2002 and 2007, leaving apartment prices in Romania's capital city, Bucharest, rivaling those of Paris and London. And when I looked at it now, the last few years, and even last year for 2013, real estate is in a complete slump in that country. So people who paid these top dollars, we think that we had a real estate bubble here. They had a major real estate bubble. I just read real estate was down, the apartment complexes were down 4.6%, and the year before it was like 3-some%. So 7 or 8% down just in the last 2 years. And that's just the last 2. I didn't go back further, but it's been going down since 2007. So there's a real estate bubble it makes ours look not too bad. Of course, it depends on what you're into here, I guess. Then we have the Mississippi bubble. So John Law is an economist in France. These are all the people from back then. Somebody did a picture of everybody that was protesting the fact that they lost all their money. In 1716, John Law established the, okay, I'm not a French person. It's the General Bank, I can tell you that, but it's Banque Generale Privée. and a year later the Mississippi Company, which ended up with a complete monopoly on France's colonial trade. So John Law was this economist who pretty much controlled all the trade in France back then. And he had a complete monopoly France on their colonial trade, not to mention that he was in charge of collecting taxes and minting money. So the company's share prices skyrocketed because, man, this guy's got the corner on everything. Everybody wants to jump in. They went from 500 to 18,000 livres a share. So the bubble finally burst when it became clear that the number of notes being issued, so he was selling basically bonds or promissory notes, was far in excess of the metal coinage the company held, and so it went tumbling down. So we had another big bubble pop and a lot of destitute people out of that. The next one was the Florida land boom, and yes, when we talk about that, there was another real estate bust in this country. In the early 1920s, daring entrepreneurs like Carl Fisher went to great lengths to promote Miami as a tropical haven, at one stage erecting an enormous billboard in New York Times Square reading, "It's June in Miami." So he got all, this is how all the, if you ever go to Miami, there's a lot of New Yorkers there. Well, this is where it all really started because he was promoting it where all the money was in New York City, so he was promoting Miami. What happened was all the supplies that were needed to do all the building boom, got clogged up the rail system, and the railroad said, we're not going to let you do this anymore. We can't operate in normal manners. All you want us to do is haul all your lumber and supplies down through there. So they stopped it. Then in January of 26, a schooner sank blocking the Miami harbor, which kept boats from coming in and out of the harbor, which were the ones that were bringing the supplies. And then also at the same time, Miami Hurricane, no, it's not the Hurricanes, I know. But, well, that's probably where they got their name. In 26, a hurricane came, put the final nail in the coffin, and local developers went bust. So all this stuff, the real estate prices were just soaring, and it went bust. And so it sounds familiar, right? 2008, did we not have a lot of that, where the real estate prices were built up and busted? It's not the first time it happened. So it can happen over and over and over. We just don't know when. Luckily, it was 1926 to 2008. It was a long period of time. Then we have the Poseidon bubble. No, this is not the Poseidon Adventure. The Poseidon bubble was in the 60s when nickel was in high demand and prices were greater than ever thanks to the Vietnam War. But industrial action against Inco, which was a Canadian company that was a big supplier of nickel, they put action against them, and it led for a supply shortfall. So supply and demand, if we go back to the basics of economics, if there's no supply but there's still demand, what happens? Prices go up, right? So Inco gets shut down or has a problem and they can't supply the market. So what happens to the nickel? It soars in price. So now everybody and their brother wants to get in there. And then there was an Australian mining company called Poseidon NL, which discovered a lucrative nickel mining site in Western Australia. And so Inco was having all these problems, and these guys went, whoo, look at this. We got nickel here, and there's a huge demand. The price is up, and it just kept soaring. So it grew along with, and then so what happened is, then all these other mining companies popped up globally in different areas wherever they had nickel. And so they all jumped in a bandwagon. They started trying to get investors in. Some of them weren't even legitimate mines. Does it even say that? I think it does on the next one. Numerous companies they didn't even have mining leases, but they were, stealing money from people, basically, telling them that they had all these deals going on. And everybody lost money because what happened is eventually the share prices plummeted. Because now we have nickel, and once the supply started coming back up, all the prices fell back down, and so people lost a ton of money there. Now we're going to get into one that we probably all have felt, the tech bubble or the dot-com bubble, which happened in early 2000. The dot-com is one of the most well-known bubbles in living memory because most of us have all been through it. Novelty and difficulty in valuing these companies led to some rather enthusiastic investments. The bubble grew to bursting point between 1995 and 2001, with investment pouring into thousands of new internet firms, many practicing risky policies of growth over profit, believing that if they build up their customer bases rapidly, then they were hoping that eventually profits would come. Well, we know what happened there. If we look at the NASDAQ, which is where most of the tech stocks are at on the market, this is July of 2000 or July of 98 to October of 2002, and there's a few of you Rubbermaid people in here. Hopefully none of you got caught up in that, but you can see from 98 till into 2000, early 2000, was the peak of the tech stocks. And there was a lot of Rubbermaid people. There was a local brokerage house that hammered pretty hard at Rubbermaid. Some of you guys might remember that. And a lot of people got put, their retirements, when they retired, got put into tech stocks. And they were booming. Again, a bubble. Everybody thought it would never end. These companies are making 1,000, 1,500% returns each year for the last few years. And man, this is never going to end. There's no risk. There's no volatility. It's a straight up line. And then the rug got pulled out from under them. A lot of those companies all went bankrupt. People lost their retirement. They lost majorities. Then there was large class action lawsuits in Worcester area because of all the Rubbermaid people got caught up in it. Now, that doesn't mean they did it everywhere, but they did pretty much. It was, unfortunately, the Rubbermaid people got hammered on pretty hard, and from their local brokerage company, and they all bought into it because they thought that it was never going to end, and so did their advisor, obviously, because he put them there. So then, last but not least, the number one bubble is the uranium bubble. And in the 70s, uranium hit spot prices of around $110 a pound, but dropped down to below $20 a pound in the 90s, and this is where it stayed until 2005. And then a perception of the future nuclear energy demand for emerging economies, reactor lifetime extensions in the West, and low inventories of uranium, again, price and demand, led to a swift increase in prices from 2005 to 2007. It caused a high spike in stock prices for uranium mining and exploration. A sharp fall post to 2007 caused many mining companies to go bust. And people who speculated, it's a commodity, people who speculated in that lost a lot of money. Again, they didn't think it was ever going to go down. I looked yesterday, or was it today or yesterday on the internet, it's like $35 a pound right now. So it never went back up to its big numbers that it was. Again, a bubble. There's other bubbles, not only Beanie Babies. Can anybody think of any other bubbles? Pokemon cards. Anybody have any kids that bought Pokemon cards?
Potbelly pig.
What?
Potbelly pigs.
Potbelly pigs. Yeah, there you go. That's a bizarre one, but you know what? They were a hot item, what, early 2000s? Yeah, now you can't give them away. Here's some other ones. The Roaring '20s stock market bubble. Japanese asset price bubble. What happened in Japanese asset price? The stocks and real estate. Things were just going really wild in the late 80s. And then they had a big bubble and real estate and stocks plummeted. I don't know if they've ever really recovered in Japan. Real estate bubble of the 2000s, which we just kind of went through in 2008. All right. So, bottom line is, bubbles happen. I'm putting it very nicely there. I'm pretty sure anybody who got burnt by any of those bubbles would probably have a different term than that word right there. So, biggest question is, how are we going to avoid bubbles? Remember, bubbles happen. Remember that when we get caught up in the hot moment, when something, everybody's talking about it, it's a hot thing, prices are going up like crazy, got to get in. These are what you got to watch out for. This is a sign. And if we're aware of it before it happens, maybe we can stop our emotions from getting caught up in it. Because we all have this little sense of greed. Whether we want to admit it or not, it's all in there. So, there's 4 things we need to look at to try to keep ourselves from getting caught in a bubble. One is to develop a healthy skepticism of ever adding or loading up on anything with a high recent price or performance. So if something has been running up, and I'll tell you what usually the signs are. If something's up really good for a couple years, everybody's talking about it. If it's up for 3 years, even more people are talking about it. And if it's up 5 years, it is the greatest thing since God. Truly, people will buy into it. Perfect example of recent times is gold. Gold in the last, well, they're for like 10 years. So it's been a couple years since gold peaked. But the longer gold had a run through the first 10 years of 2000s, the longer it had a run, the more advertising you saw, the more people who talked about it. But if you look historically at gold, it averages just a little over 4% per year historically. But gold had a good run. So what happens is it's got this high performance. It's doing well. It's done it for a couple years. Now it's done for 3 years. Now it's done for 10 years. And if you go out there, there's portfolio managers out there today that will tell you gold is an awesome diversifier in your portfolio. But there's no proof of that. Only thing they're using is the last 10 to 15 year history. So what's 10 to 15 years out of 80 or 90 years of market returns? It's not long enough. You need longer data to be sure that it's an accurate, not a bubble, it's an accurate asset class that's worth putting into your portfolio. So a perfect example was back in early 90s, emerging markets started to be talked about a lot. And in 96, I believe it was, that Matson Money actually added emerging markets into their portfolios. But during the 94, 95, 93, 92, it started to be this hot topic. And so what everybody was, the money managers, because they had a session on this when I was down in Cincinnati, they had a session on some of the discussions of why they added what they added over the years and when they added it. But one of their reasons was they were looking at emerging markets at that time because it was a big hot topic. So they toil a lot with, is this just a bubble or is it for real that this is a good asset class? Is it a good diversifier to add into our portfolio? And so 94, 95, you can see that if you put 10,000 in up here in January January of 94, and kept it there till the end of 95, 10,000 would have turned into $8,800. So when Matson looked at it, they had looked at these numbers, and this was at the end of 95, and they're like, well, this thing's gone down, so it probably really isn't a bubble. It had a couple good years, but it probably isn't a bubble because it's been down the last couple years. So if you add those 2 years together, 94, 95, we have about a little over a 12% decrease in value. So what Matson's did, not just him, but the money managers did, is they decided to add emerging markets. Some of the academics came out and said, look, there's a great diversifier with adding emerging markets. You're going to add more countries to your portfolio, and it has a higher premium than U.S. stocks. More volatile. What higher premium means is, historically, it will give you a better return. However, it has a bigger roller coaster ride to it. But if you add it in your portfolio, you're going to have to find some way to keep your portfolio from having higher increase. So they added emerging markets. And as you can see, in 96 to 2010, the timing was impeccable for them. But that's when emerging markets really came to fruition from the academic standpoint. So it isn't a surprise that they went up, but you can see they still bounced around. But they have now gone, if you had 10,000 back in December 95, it's now worth over 36,000 at the end of, 2010. So it did very well, and it's panned out to be a great asset class. And if we look at this big dip right here, what would most people do if they owned that? Probably would have bailed out right in here, wouldn't you think? But remember, in our portfolios, and I brought it up earlier, is rebalancing. And they're doing that right now this week on our portfolios. What that means is when some asset class is down, there's an asset class somewhere that's up, and they're going to be selling what's high and buying what's low. So in this particular case, instead of all of us, if we'd have been in there at that point in time, instead of us bailing out or the money manager moving out of that asset class, they were actually buying more of it. And for 2013, the bond market, the bond portfolio, or the bond mutual fund, ended up down just a little over 1% for the 12-month period. Stocks soared. The international fund was up over 39, and the U.S. or international was up a little over 22. The U.S. fund was up a little over 39 for the year, but bonds were down 1.04. You know what they're doing today and tomorrow and the next day? They're buying bonds. They did it all last year. When you and I wouldn't do it, right? Would you want to go in there and buy this when something else is soaring? We wouldn't do it. That's how we're going to make money, though. You buy low, sell high. It's so simple, but it's hard to do. Emotionally, we don't want to get caught up in it. If you look academically, for academics to say trending, they need at least 60 years of data, or they won't even say it's even worth looking at. But so much of Wall Street will look at 10 years or 15 years and say, that's what it is. It's great.
Worst thing in grain markets, we'll look at the 10-day trend.
Yeah.
We'll get a 6-week trend. It's a 6-month trend.
Right. But you're not investing in that for the long haul. That's a quick flip type item. You want to get in, get out, get in, get out. Where when you're investing with your assets, you want to hold them for 10, 20, 30 years. It's not something that you can look at short-term trending on that. Unless you're going to be an active trader. If you want to be an active trader, kind of like you do with your grains, you're buying and selling all day long every day.
You said that's what they're doing here. They're selling at the top, buying stuff.
Well, this would just be the...
They're an active trader, too.
They are, but they're not active daily or by the hour like some people would be. If you're going to look at short-term trends, then you got to trade constantly all day long. We don't have any clients that do that. I've had people come in, and if that's what they want to do, I always say, go open an E-Trade account and do it. You don't need me. I'm not going to do it for you. That's crazy. That's my hard-earned money. I'm not playing with it. Okay, does that make sense? So investors have a hard time with that. Here's another example of a bubble. This is January of 94 through December or January of 2000. So this is in the 90s. Remember in the 90s, you could throw a dart. Did anybody ever hear me talk about John Stossel, who did the 2020 thing? In the early 90s, he said that, he says, a monkey could throw a dart and make money in the 90s, which was true, because everything was just going crazy. And so he tried to find a monkey to throw the dart, but he couldn't find one. He wanted a Russian monkey, too. And he couldn't find one, so he did it. He did this on TV on his 2020. So he sat in a chair, and he had this whole wall of stocks, U.S. stocks. And he threw his dart, and I don't remember if it was like 25 stocks or whatever the number was. He took what he did this, hypothetically. He took those stocks and wrote them down, and he tracked them for 3 years. He kicked the pants off of all the money managers. And he had no idea what he was doing. And he tells this story so well. I saw him speak, and he's proud of it, But he said you could throw a dart. Literally, a monkey could throw a dart and make money in the 90s. So, and here's a perfect example. December of 2003, you put 10,000 in the S&P 500. So here's the S&P 500 up here. Look what it did. It was flat for a couple of years, but it just shot straight up. You couldn't do any wrong. Do you think that's a bubble? Yeah, that's a bubble, because everybody's pouring into it. Everybody's like, man, that S&P 500, it's awesome. I'm putting my money in there. But you know what? Eventually, it's got to end. It always does. So, and if you look at the small value stocks, they ended up down here. So if I put 10,000 in, I would get almost 35,000. If I was in small value stocks, I would have ended up with a little over 24,000. Same money in that same time period. If I was in international growth stocks, which are large company stocks, I would have only made a little over 20. So what do you think people down in here were doing when they saw this going on? They were moving their money out of there and going into there. And this is not active trading. These are people who own mutual funds and are sitting there, and somebody at work goes, well, I'm in the U.S., I'm in Rubbermaid, or I'm in this stock, or I'm in this mutual fund that's made up of all big, large U.S. stocks. I'm making all kinds of money. And this guy's over here going, well, I'm doing okay, but I got, I'm going to move my international stocks and go over here, because it's never going to quit. It's going crazy. Look at all the years that it just had a great period of time. And if we look at that, S&P, 37, 22, 33, 28, 21. If I'm in international stocks, I'm not seeing any of these big double digits right here, am I? So if somebody over here is bragging about it, I'm starting to think, ooh, or you hear it on TV or whatever, newspaper, magazines. So I start getting caught up in, oh, this is never going to end. Look at that run. And if I'm over here in small stocks, you can see, oh boy, this went down, but that went up 28%. I need to move all my money over to there. That's where it's at. And if you did that, here's what happened after that. This is 2000 to 2005. You can see the blue line, which is your S&P 500 index, had a period of time, 5 years, of negative returns. So if I waited to get back in that, up here, anywhere up in here, I now was going to pay the price because I was following the pack, following the herd. So, and then if we look at the international stocks, they ended up down, and the small values had a tremendous 5 years. Who would ever known it? Nobody knows. But we need to own all this stuff. In our portfolios, we got all this stuff. And you know, that's why you can't move money around thinking what's going to be the next hot item. If I had to gamble today on a hot asset class, I would say emerging markets are the place to be for the next 5 years. But I would never bet on that because I'll probably be wrong. But they have struggled they've trailed U.S. stocks, they've trailed a lot of other stocks, Asian stocks. The emerging markets have trailed that. So they're probably due for a good run. And some money manager will say, well, based on trending, we think we're going to move over to here. What if they miss it? What if the emerging markets don't take off for 4 or 5 more years and the U.S. market continues to climb? You can't move around. We can't try to predict what asset class is going to be hot going forward. So what we do is we want to own all of them. And we want to look at the histories based on 60, 70, 80 years of history and study by academics who don't have any money or any skin in the game to tell you where you should put your money. Wall Street creates fear for transactions because they make money. Academics aren't going to make any money on you. They're not there to tell you to trade and buy and sell. They're going to do academic studies and get histories. So, just a little lesson of the bubbles of the stock market. The second thing to do to keep from getting yourself caught in a bubble is insist on academic proof that asset categories have expected market premiums and diversification benefits. So what that means is, let's go back and just talk about the market premium. What a market premium means how much more will I make if I invest in that compared to this. So in this particular example, we got treasury bills, which is what most of your savings account, money market accounts are all based on treasury bill rates. Real short-term money. Federal government's considered the safest place to invest your money. If I invest in large company stocks, historically, and we're going back to 1927 here through 2011, historically, stocks have made 7.8% more money per year, higher return, than if I just invested in CDs and money market accounts over that same period of time. So the premium is 7.78%. So let's look at an example. Let's say treasury bills did 3% per year, and this did 7.78. That means that stocks, large company stocks, did over 10% better, or that would have been your return, over 10%, while treasury bills were making 3. So long-term historic histories say that large company stocks have a higher premium than cash. We'll use the word cash. Then you have the size factor, which says small stocks have a premium of 3.15% better than this category. So if we add 3.15 and 7.78, we're over 10%. If you invested in these, historically, they've done 10% per year better than if I invested in a money market or savings account. That's the premium. Now, how do I get that premium? They just don't give it away, right? You got to take a little risk to get there. But that's what we mean by premium. And then if you look at the price factor, high book to market value stocks are value stocks, okay? So value stocks have the highest return of all stocks. It's 4.68% above this. So just think, if we start adding these, this is called the 3 model factor, by the way. Eugene Fama, French and Fama designed this way back in the day. But their idea was that we figured out that stocks will do better than bonds or cash, that small stocks will do better than large stocks, and that value stocks will do better than small and large stocks. This is the basis. This is one of the core values of our portfolios. You don't see it, but that's what's in there. So one of the things that we're saying is that academic proof, that's academic proof that we're not just going to go buy small company stocks for any old reason because it's hot. We're going to buy it because we know it has a premium to large company stocks, which has a premium to cash. There's a reason why we're owning them. Then the other piece to this puzzle, is diversification. And I've talked about this many, many times. Why do we diversify? Well, Harry Markowitz did this study way back in the 50s and actually became reality he won a Nobel Prize in the 90s on this. These are correlation charts, which means if I own U.S., let's say top large company stocks in the U.S., S&P 500, and I own international small stocks as an example, 74% of the time they move in the same direction. So when the U.S. large stock market is up, so is international smalls, 74% of the time. But 25% of the time they're in opposite movement. So what that means is if I own large company U.S. stocks and they go down, 25% of the time international smalls are up. So why get caught up in all one asset class when we can own a couple? So that when we have a major U.S. market downturn on the big company stocks, we might own some U.S. or some international small that's going up. It helps absorb or smooth out the roller coaster ride. So diversification is another reason why we don't get caught up in bubbles and how you stay away from getting caught up in bubbles. Diversify by the histories and the studies, and that's how you're going to beat getting caught into a bubble. Because if we follow the pack, if we follow the hot new item of the day, we might end up loading all our money in one of these asset classes over here, and then that goes bust, and we just got caught in a bubble. So number 3 is understand the definition of market timing. All right, the simple definition of market timing is what? Get out of the market and go to cash. Okay, I feel better now. I'm going to get out of cash and go back in the market. That's a basic market timing. Market timing, any attempt to alter the mix of assets, mix of your assets in your portfolio based on a prediction or feeling about the future. So if you listen to me tonight, you'll all be wanting to go move everything into emerging markets because you think it's going to be, because you think I know everything. And you're going, right? You're supposed to say yeah. So you're going to move everything into emerging markets, and then if it busts, you followed the pack. So the idea is we can't time, we can't predict. We need to own assets based on different asset classes to diversify so that we don't get caught in one asset class bubble. Here's a perfect example. History of the market does this, right? Boop, 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 boop. But over the long haul, it goes up. So we're on a roller coaster ride all the time, but if you look historically, it's always an upgrade over long periods of time. You know what will happen 50 years from now when we go look at these graphs right here? This line that goes up right here? This little dip, let's say this one right here is 2008. It looks pretty big on the graphs right now. If you go back and look at a 10-year graph, 2008, well, I showed it, that big V it showed on there. But you know what? 50 years from now when we show it, it's going to be just this little blurb on there. It's funny how that works. If you look at a 60-year graph compared to a 10-year graph, you start to forget about that little blurb because it's a spot on the radar screen. So what happens here is this is what's really going on all the time. And what we should be doing if you're in a bubble is we should get out when things are up there, right? And what we should do is get in when they're down there. But we do the opposite. Okay? So when we do rebalancing, we're doing exactly that every quarter. You guys don't have to do it. We're paying a money manager to do it. Rebalancing means today, tomorrow, and the next day, they're looking at all the asset classes. You got 19 asset classes in those portfolios. They're looking at what's down and what's up. And they're going to rebalance those to the percentages that they had you originally at to keep you efficient. And that means what they're doing is they're selling what's high and buying what's low. And that's how you stay efficient. Instead of getting caught up of where we think we're going to be or what emotion you got based on news media or what Brad says. By the way, I got some emerging market stock if anybody's interested. A little high prices tonight, but it's going to keep going. Okay, and also know where your returns come from. In the initial meetings that we did, separating the myths programs we did initially for everybody back a few years back, this was one of the slides out of there. And what it basically says is that Brinson, Hood, and Biebauer are these economists that did these studies, and they said, where do returns really come from? And if you look at it, only 1.8% historically, they went back a long period of time, historically only 1.8% of your return in your portfolio, this little yellow sliver, is what market timing actually does for your return. 2.1 for other factors, which would include rebalancing. 4.6% for stock selection, so if I select my portfolio accurately, and if I do asset allocation, which ours are all asset allocation, they're all stock selected, and we have rebalancing going on. So if you add those three together, about 95, 96% of the returns actually come from just doing that right there. The rest is all speculating with market timing. But so many people are pushing it today. It's called tactical asset management. If you read about it, any money manager says, oh, we do tactical asset management because we have this research team that knows where everything's going. Run. Don't walk, run. Because that means they're market timing. It's a fancy name for market timing. That means they're going to move stuff around because they think it's going to be hot. Oh, this sector's going to be hot. This is not going to be good. We'll move it over here. Hey, there's no skin off of their back, really, is there? They want to perform, but they make money when they move stuff around. We're not going to do that. So here's a recap. 4 things are going to keep all of us from getting caught in a bubble. So don't anybody call me and tell me you're in a bubble. And I've had these phone calls. I'm pretty sure my dad's had those phone calls. Develop a healthy skepticism, all right, of ever adding, loading up on anything with high recent performance. Insist on academic proof for asset categories. Expected market premium, make sure you're diversified in asset classes, and make sure that the reason why you're buying those asset classes is not because they're hot for the moment, but because there's an expected long-term premium for owning those asset classes. Understand the definition of market timing and know where your returns come from. Okay, does that make sense? Did I put anybody to sleep? We got a little bit more to go. How are we doing time-wise? Ooh, I got 5 minutes. I'm getting pretty good at this. Okay, 10 ways you know you're investing in a bubble. If everybody is talking about it, it's probably a bubble. Gold was the last big bubble I think we had was gold. 2 years ago, it plummeted. I had a guy came in my office. I probably told this story before. Came in April of 2012. Gold was pretty high. I think it was like, I don't remember what it was. It was 16 or somewhere in there. It was still pretty high in April. I think it was 12. I don't think it was 11. It was 12. And he wanted to buy gold. And we could buy him gold. And I said, what do you want to buy gold? Oh, they say it's going to go to $3,000 and blah, 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 blah. Blah, 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 TV commercials and all the internet crap. And I said, well, I'm going to tell you right now, you're going to have to go find somebody else. He wasn't very happy. He's a client. He wasn't very happy with me. I said, you're going to have to go somewhere else because I'm not going to sell it to you. I'm going to tell you right now, that is a bad idea. And he wanted to buy grain futures. Now, if you're not a farmer, it's probably not a good idea. Scheif is a farmer. He can...
Corn was $7. Today it's $3.90.
There you go. And you would have thought it was never going to end last year when it was at 7. So same thing with gold. This guy wanted to buy gold. I turned him down. I think it was about a year later. Gold actually started just really going down after he was in there. So it was like, whew, I make it look like I was a hero, right? He came in like a year later and he goes, you know, I never did buy that gold. After I left your office, I just couldn't do it. If you didn't want to sell it to me, I didn't want to buy it. And he had the checkbook laying right there. He wanted to put $50,000 in it. I could have sold it to him and made money on it. I'm just not going to do it. So anyhow, he was thankful a year later that I kind of gave him a wake-up call. But that's what happens. And gold's only popular when it's going up, when it's up. When gold's 10 years ago, you didn't hear anything about gold when it started its climb. We only heard it the last couple years when it hit its peak. Because that's when the news media is all over it and the guys selling it are really pushing it. But when it was in the first 3 or 4 years when it started to go up, that's when you needed to be in it. But nobody was talking about it. So when everybody's talking about it, don't go in it. It's a bubble. Now, if it's cool, it's really cool if you own this, or this is really hot, it's cool, man. That's another sign of a bubble. If it's on a magazine cover, this one says, what this is March of 2000. Here's the NASDAQ, okay? This is the tech stock bubble. So Money Magazine came out in March of 2000. How to invest in the hottest market ever. Hot stocks, safe stocks, the trouble with tech. So they're out there pushing, tech stocks had this huge run up. Remember that graph I showed earlier? Look what it did after that magazine came out. Whoo, boy, I hope nobody bought into that. Money is probably one of the better magazines for that, getting caught up in the bubble. If there's endless commercials on Glenn Beck, nothing against Glenn Beck other than he is a big gold line pusher which pushes gold. Okay? Trust me, there ain't no money there, is there? Do you think there's any money being made by him having them commercialize on that station? And trust me, he's going to be a gold bug because he's making money on that. It's television, baby. I don't care what they say. It's a bubble. If it's a place to be, the herding mentality, right? That's where everybody's going. That's where I want to be. It's a bubble. Now here, remember I talked about 2 years, 3 years, 5 years. If it's been 2 or 3 years and it's unbelievable returns, it's a bubble. I got Beanie Babies for sale. And actually, I have that rare one. I'll sell it right now for $25. It's probably worth a nickel, but if every financial advisor is adding it as a new diversifier. So I already talked about this because we're seeing this a lot in the last 3 years. In 2008, we had complete failure of everything, right? Real estate fell, stocks fell, bonds fell, things fell. Now, I'm not going to say everything, but a majority of what we all owned was in our investment portfolios. So what money managers are today, they're going, wow, gold was a great diversifier because it went up in 2008 when everything went down. So you should add gold into your portfolio. That's what you need to do. And so what guys are doing, they have their basic portfolios, but then this is core and explorer. This is core investments of stock and bonds. This is what you should own. And then they're adding, here's some global bonds, short funds, high yield bonds, managed futures, commodities. They're saying you got to add commodities in there because when the stock market goes down, those are going to go up based on the last 10-year history. Hello? Another bubble. You don't know that commodities or gold, if you go back the last 80 years, and absolutely no proof that gold is a diversifier to stocks. But if you go back the last 10 years, it looks awesome. So they push it. They're pushing them now because it's a hot thing. It's the hot ticket. If it has a popular story attached to it. I think we've talked about Beanie Babies, had a popular story. Potbelly Pigs. Everybody wanted one. Oh, they're so cute. It's a bubble. Now, if there's a dummy's guide to precious metal investing, I'm pretty sure it's a bubble. And you know what's funny is my father-in-law, who's not here tonight, and I wanted to pick on him, is he gave me the Texas Hold'em book for dummies. I've never read it, but I just thought it was kind of funny because Texas Hold'em, and he gave that to me like 4 or 5 years ago. Remember Texas Hold'em was like the hot thing on TV? Now it's reruns all the time if you watch it, but it's just funny how that truly was a bubble, I think. And if there's an infomercial about it, it's probably a bubble. Mattson throws this in there. How a globally diversified. So his point with this is that our portfolios are so boring that they're never going to make the cover of Money Magazine. Okay, so here's Mattson. He says, oops. How a globally diversified portfolio based on modern portfolio theory, efficient market theory, and the 3 model factor combined with lifelong discipline and coaching delivers strong, steady returns, vastly superior to the Dalbar studies. Is that going to sell a Money Magazine? Probably not. So Mattson's point is, we're never going to make the cover of a magazine because what we do is boring. But what we do is 3 things, and we talked about it at the last meeting. We own equities. We diversify our equities, and we rebalance on a regular basis. It's that simple. But everybody in the media world wants to make it look like you got to have movement. So we're never going to see Mattson on the front of Money Magazine. Maybe we'll see him somewhere else. Let's hope it's not with Bernie Madoff. No. Just kidding there. Trust me. We're good. We don't get paid to chase bubbles. Bubbles equal severe volatility. When you have severe volatility, somebody loses, and it's usually the last people in because they follow the pack. And usually it's everybody because nobody thinks the bubble's ever going to end. So bubbles create the delusion of safety because you feel like it can never go down. It's the general consensus among the population. Everybody's doing it. We're all herding to it. Rebalancing is to investing as move more, eat less is to weight loss. So remember we talked about this at the last one. That's why I wanted Martin's wife here because she was worried about me. Move more, eat less. It's that simple to lose weight. But why is it a $7 billion industry? Because it's so emotional. Behavior gets in the way of what we know. We know that if we move more and eat less, we'll lose weight. It's that simple. Same thing with investing. Own equities, diversify them, and rebalance. It's that simple. But we get in our way, just like everybody else gets in their way with weight loss. It's a management, it's a behavior, it's emotions. I'm guilty with weight, but I'm not guilty with stocks that way. So the 3 C's of investing. What was this guy's name? Jiminy Cricket. That's right. He was the conscious for Pinocchio. So the 3 C's, we got to remember this. Conscience is there's 2 kinds of conscious, okay? The inner sense of what is right or wrong in one's conduct or motives. So conscious means we know what's right or what's wrong, what's moral, what's unethical. That's what our conscious is. These are things that we know. Then you have your conscious, which is an adjective, is aware of one's existence. So that means if I'm conscious, I'm aware of what's going on right now. Or my conscience knows what's right or wrong, right? So we have to become aware of these things because that's what keeps us from getting caught in these traps and these emotional behaviors, is being aware. Fully aware of what's going on. And then the last one is caution. Alertness and prudence in a hazardous situation, care or wariness. Warning against danger or evil. So if we feel like we should be caution, we should use caution, then your gut feeling's probably right. So be conscious of what's going on. Use your conscience and use caution. And be very particular about what you think you're going to put your money into because you can get caught up in that hot bubble anytime. Isaac Newton did it. We can all do it. So that's it for me. Anybody got any questions on anything? Yes.
It seems to me like everything that was talked about is directed to people who are not currently investing. Is that right? I mean, because as long as your risk tolerance is right.
Not really. And you're in a way, but I'll tell you what happens is if we keep doing these classes and we talk about this, there will be that hot moment when the market crashes and you become emotional. And if you're reminded on a regular basis why we do what we do, then that's the constant reminder that will keep you falling into a trap. And the trap is trying to market time it. I got to get out. I got to get out of my mess. This is never going to come back. Blah blah blah. This is why we do it over and over. And I know some of it is repetitive. That's the idea of it. Because if we hear it over and over and over, we finally start to get it. Because if we don't, we have another 2008. I guarantee you're going to feel lousy if you aren't up on what we've been talking about. But if you're in the market for the long haul, and everyone in here that has done business with us knows that we have sat down exactly what kind of time frames, what kind of risk levels you're willing to take. There's no reason to change anything if the market crashes tomorrow. Because it will come back. It will come back. And if it doesn't matter. You can have 10 million or 10 bucks. It doesn't matter. The money's worthless. So take that fear of complete loss of everything away because there's nothing you're going to be able to do about it. So you got to be reminded not to panic when that happens. And right now, it seems repetitive. It doesn't seem like, I don't need to hear this over and over and over. Maybe somebody who doesn't know it needs to hear it, but we really do need to hear it over and over. And I can tell you right now, as an advisor, who has been through lots and lots of classes of this stuff, I still can get caught up in it. I still can read something on the internet and go, oh boy, wonder if that's true. So it's not just you guys. Us advisors are probably worse than investors. Most of the advisors are, because I can tell you right now, they freak out and move stuff all the time. I even think about it, and I know better. So don't feel like it should be repetitive to you, and it should feel like hey, I feel comfortable. Karen, you might feel comfortable with that, and that's great. I'm glad you do. I hope everybody does. But there may be a day where you read the right thing at the right time, at the right moment, and you go, ooh, maybe I'm not doing the right thing.
Does the risk factor enter into this in any way?
Take high risk. No, I don't know. What?
As far as a person being a risk factor of 25 to 30 versus a person that's 90 to 100.
Absolutely. But you still have to own all the different asset classes no matter what risk you're taking. If you want to take a low risk, you just own more bonds in your portfolio than you would stocks. And if you want to take more risk, you own more stocks. But you still, even in our conservative portfolio, we have almost 13,000 holdings. In our most aggressive portfolio, we have almost 13,000 holdings. The same holdings, except if you're in a 100% bond fund, you're obviously not going to have any equities or any stocks in there. But if you have maybe 25% stock and 75% bonds, which is a conservative bucket, you're going to have the same holdings the guy has that's totally aggressive. You're just going to have more percentage in bonds than you will in the stocks. And less okay, remember I talked about value stocks, highest return, highest risk, small stocks, higher return, higher risk than large company stocks, which is all higher than the treasury bills. Remember that slide? So basically what we do is, depending on the risk, how much do I own, weight my portfolio more towards that. But we all own the same stuff. It's just a matter of how we weight it. How much of each do you own? But risk is hugely important, and that's why we sit down with everybody and we do, if you remember standard deviation, that's where we go through standard deviation. That helps you measure risk. It puts a number to the risk you're taking. If you ever get uneasy about it, we have to talk about it. That's what we're here for. We don't want you to get emotional and freak out on us. Any other questions? Good? Class dismissed.